Andrew Ferris, Senior Investment Advisor with BNP Paribas Wealth Management, joins us live from Hong Kong. Andrew, morning. Thank you for joining us. Andrew, if I take the clock back, what dominated global equities or global asset classes, at least for the quarter gone by, was the effect of LTRO2 and the cheap liquidity. What do you think will dominate global asset classes for this quarter?
Well, hang on a minute. The LTRO was for the European Union. It was not for the United States. As most definitely, it was not for Asia. So let's not mix up the things together, because, of course, Asian markets, and specifically some of the smaller markets, performed extremely well, and some of the markets are still very, very low to the low teens or even to single number increases. So I think it is very wrong to take the LTRO, which was primarily a European initiative, and spread it globally. United States markets did quite well, so did Japan. The European markets, selectively, some of them did well, and so selectively did Asia. So I'm afraid I don't buy the story that it was a LTRO that drove all markets, because most definitely it didn't.
Andrew, hi, morning. There's good data coming out of China this morning. Their factory activity now seems to be stabilizing, and the HSBC Flash PMI has come in higher than street estimates. Do you think concerns of a hard landing in China was sort of overdone, or do you think those concerns still remain pretty much?
I have to express my great dissatisfaction with the notion of hard or soft landing. Nobody, but nobody, defines what is soft or hard landing. So I refuse to speak about it, I'm afraid, because if there is no definition, then I have to give you my definition, and of course it's going to be my definition. There is no such thing as soft or hard landing. There is acceleration or deceleration of economic growth. China has been slowing down for nearly 2 years now. It started at nearly 10.5 2 years ago, and it's now at 8.1. Now, is that soft landing? Hard landing? I have no idea. So when I look at the Flash PMI, I'm in the least concerned whether this is proof that it has soft landed or hard landed. All I know is that the Chinese economy will very likely continue to slow down, because the authorities most definitely would like it perhaps to go just below a little bit of the 8% mark. And that, of course, will continue to be reflected on equity performance, because with an economy which is slowing down, earnings cannot be expected to accelerate. So I'm afraid not only I don't have any views, actually I don't want to have views on something which is so ill-defined as the hard or soft landings. I'm sorry if I'm a little bit extreme, but this has been thrust around so much, and it is an irresponsible, a little bit journalistic approach to declare China has soft landed. Who says so? Okay, what is soft landing and what is hard landing? Nobody says so. And therefore, it's a little bit of a non-term.
So let's discuss the topic, and I'm sure that you have opinion on this one. The outcome of French election, and how do you think this will have an impact on EU's future monetary policy?
Both the key candidates are confirmed Europeans. In other words, if Mrs. Le Pen was about to win, then that was going to be an altogether different proposition, because she wants to take France out of the European Union. Now, between the two candidates, all we are looking at is differentiation on the domestic tighter fiscal policies. And frankly, I don't think this is going to change significantly France's position within the European Union, although of course there will be potentially some significant differences whether Mr. Hollande or Mr. Sarkozy is the next president. So again, I'm not holding my breath as far as Europe is concerned on the differentiating aspects between the two presidential candidates.
But given the way how US economic data of late has moved, I mean, there are mixed set of reports. The growth is anemic and unemployment rate has improved. Do you think once Operation Twist ends later this year, we may not get a QE3?
Well, again, QE3 depends how this is defined, and the Fed has been incredibly reluctant to say anything explicit or positive about QE3. From my point of view, as long as you have a central bank which only a few months back, I think 3 months back, said we're going to keep effectively zero interest rates till the end of 14. Remember, we are 12, we're year 12, all the year of 12, all the year of 13, and possibly all the way down to 14. I really don't need to hear about quantitative easing 3, because to keep interest rates at effectively zero interest rates, you will need to continue to pump liquidity into the economy. So I think it is differentiating factors and sometimes simply words, okay, that will be driving the markets. Yes, the markets would have liked another injection of liquidity which comes into a single lump as opposed to a guaranteed effectively zero interest rates for effectively the duration. Frankly, as an investor, if somebody tells me this is what's going to happen for the next 3 years, for me it's an eternity.
Fair point. Andrew, amidst all the global uncertainty as well as developments, how would you approach India now?
Very, very cautiously, because the RBA made it absolutely clear. They can't make it any more clearer. We're not going to cut interest rates till fiscal policy is back in line. Full stop. So now, from now on, I'll forget about the RBI and I'll simply concentrate on fiscal policy. And I'm afraid this is not something that I can observe it on a week-to-week basis. I can see what interest rates are doing, I can see what the rupee are doing, I can see what Sensex is doing, but the fiscal deficit is something that we are going to observe on a quarter-to-quarter basis. Therefore, I think the RBI, for all intents and purposes, is done. They've made it very clear that they are not going to cut until and if the amount of the amount of borrowing that the government has to do, and the amount of, by necessity, the amount of excess of expenditure over taxes they are going to do is going to be the key determinant of their next monetary policy step.
So for rest of the year, Andrew, are you a dollar bull or are you a dollar bear?
I'm afraid I have no idea what that means. Okay, because I don't buy the US dollar, I buy US dollar assets. Okay, so, most definitely I would not buy the euro dollar on a cash basis for its returns, because I'm going to get 25 basis points. For example, I'm a huge Aussie bull on its own basis, because that's the only major currency that can still give you nearly 4% for an overtime deposit. So, I'm afraid I will need to answer the question in terms of assets as opposed to currencies. I don't buy currencies. So I buy assets.
Fair point. So the dollar index right now is at about 79.5. Dollar index, the basket of dollar with other currencies. What's your view on the dollar index number for rest of the year?
0, actually. That particular index is very useful for macroeconomic analysis and for general views. I can tell you, I don't know of any single investor that buys or sells the index or has his returns in index. So the fact that it is below 80 leaves me utterly indifferent. Actually, secularly, in the last 5 years, an index has been declining, meaning that the US dollar has been becoming weaker against its 5, if I remember well, trade-weighted components. So remember, an index, it is just, particularly a currency index, it's just that. It is a currency index. You cannot buy the components. It is just an overall indicator of how the US dollar doing against 5 or 6 either major currencies trade-weighted. So the fact that it's below, actually, it has not been below 80 all the time. It was above 80 in March, and most definitely was above 80, if I remember well, just before Christmas. But as I said, I look at the index academically speaking, not in terms of any market significance.
Fair point. Andrew, what about markets in the Far East, North Korea for instance, and do you think a nuke test by them could destabilize the market, at least the Asian pack?
None whatsoever. All the tests of the North Korean had zilch impact on South Korea and on the rest of the world. They might have a minor impact on the day, okay, but I think even if they explode another dirty atomic bomb, the impact is going to be absolutely temporary. The markets have an unbelievable capacity of completely deflecting or ignoring what are potentially minor political events.